All eyes to the Federal Reserve after months of volatile economic reports, investor uncertainty, and shifting inflation trends. This week's policy decision could set the tone for mortgage rates heading into 2026. Good afternoon. We are heading into a pivotal week of the final Federal Reserve meeting of the year, and after months of data swings and mixed signals, the market is finally leaning toward the possibility of a rate cut. As a reminder, mortgage rates are heavily influenced by two major forces, the labor market and inflation. Any economic report that shifts expectations around inflation can move mortgage rates. Now, for example, a weaker jobs report from the Bureau of Labor Statistics suggests consumers may spend less, easing inflationary pressure. On the other hand, stronger than expected retail sales point to more spending and higher inflation, pushing rates upward. Understanding how investors react to these headlines is one of the most important keys to understanding mortgage rate trends, and this week's data and Fed decision will give us plenty to watch. With that in mind, let's dive into what took place last week and how it affected mortgage rates. Here are your headlines. Now, speaking of labor market strength ahead of the Fed meeting, we learned a few weeks ago that the BLS will not be releasing October's job report due to the prolonged government shutdown. With key data missing, Fed members have been leaning more heavily on private payroll figures from ADP to help guide their upcoming policy decision. The private sector shed 32,000 jobs in November, according to ADP, well below expectations. Small businesses had the largest cut with 120,000 jobs, while medium-sized firms added 51,000 and large employers added 39,000. Wage growth still favors job switchers, up 6.3% year over year versus 4.4% for job stayers. The gap has narrowed to 1.9%, the smallest in 5 years, signaling less competitive hiring. So what is the bigger picture? The private sector has lost 17,000 jobs over the past 4 months. ADP chief economist Nella Richardson described hiring as choppy, citing cautious consumers, an uncertain economy, and broad slowing led by small businesses. Now, in other labor news, initial jobless claims fell by 27,000 to 191,000, though the decline was likely influenced by Thanksgiving, since many people delay filing due to travel or holiday plans. Continuing claims also dipped slightly to 1.939 million, but they have stayed above 1.9 million since mid-May, signaling ongoing strain for those already unemployed. Now, Challenger, Gray, and Christmas reported 71,000 job cut announcements in November, a 24% increase from a year ago. Restructuring from employers was the primary driver last month, while DOGE impacts remain the leading cause of job cuts for the year. Employers have announced 1.17 million cuts year to date, only the sixth time since 1993 that totals through November have exceeded 1.1 million. Hiring plans are also weakening. Year-to-date hiring announcements are at their lowest level since 2010, and seasonal hiring plans are the weakest since 2012. So what is the bigger takeaway? Persistently elevated claims, rising job cuts, and weak hiring plans point to a labor market that continues to lose momentum. Now, in inflation news, the government released the delayed personal consumption expenditures report for September, coming mostly in line with expectations. Overall, inflation rose 0.3% for the month, nudging the annual rate from 2.7% to 2.8%. Core PCE, the Fed's preferred measure, which excludes food and energy, rose to 0.1% in September and edged down slightly year over year from 2.9% to 2.8%, just a touch better than expected. So what is the final thought on this? Inflation coming in on target strengthens the case for a Fed rate cut, especially as job growth continues to cool. If the Fed moves forward with a 25 basis point cut this week, it would mark their sixth rate cut since they began raising rates in 2022, totaling 175 basis points of easing. Now, as we close out the end of the year, continued momentum is exactly what the market needs after 3 turbulent economic years. One important reminder, the Fed funds rate is the rate banks use for overnight borrowing and does not directly determine mortgage rates. While there is a loose relationship, it's not uncommon for mortgage rates to move in the opposite direction of a Fed cut. In fact, during the last 5 rate cuts, mortgage rates have actually jumped higher immediately afterward, largely because investors react more to Jerome Powell's tone and outlook during the press conference than to the cut itself. Right now, the 10-year Treasury has climbed back up to 4.17% after dipping down to 3.95% in mid-October. Any constructive comments from the Fed this week could help bring stability and potential relief to longer-term rates. I'll be filling you in with an update next Tuesday, but for now, have a great rest of your day.